Hello and welcome back to Chapter 11. Well, not welcome back. This is our first time. We're just starting it. Okay, Chapter 11 is depreciation, impairment, and disposition, or getting rid of the asset. So, depreciation, the definition, also CCA calculations, I'm going to leave for tax, where you can do that, and we're not going to worry about it in this course. Okay, just going to autofocus this. Okay, so depreciation, also known as amortization, is a means of cost allocation. It's not a method of valuation. This is an error many students make. So the book value is not equal to the asset's worth or fair value. It might be by accident, but generally it's not. Depreciation involves allocating the depreciable amount of property, plant, and equipment over the periods expected to benefit from the use of the asset. So this is using the matching principle, where we match our expenses, which is the depreciation on the assets we're using, over their life, so that as they were used to make money for us, we'll match the expense to the revenue. And the allocation is generally recognized as depreciation expense. So, some things that you have to think of when you're going to be depreciating. What asset components are depreciated separately? And we'll talk about that here, but for example, the building will be separate from the roof, which will be separate from the HVAC system. What is the asset's depreciable amount? Is it going to be cost? It's always cost minus salvage or residual. Okay? And again, we're going to talk about all these things. Over what period is the asset depreciated? So are we talking useful life? Whoops. Or physical life? And what pattern best reflects how the asset's economic benefits are used up? Okay, so when you're going to depreciate, picking a method, figure out some of the things we have to estimate. Those are the questions you're going to look at as we go through this chapter. Okay, so let's first talk about componentization. This is new to you. You probably didn't talk about it last year. So each significant part, like we set up here, 3 parts to the building, of a PP asset should be identified and depreciated as a separate component. Now, multiple components may be grouped for calculating depreciation if they have the same useful lives and depreciation methods. Okay? In the questions, in real life you'll have to decide that using your professional judgment and so on. But on tests we'll tell you what the components are and what their life is and everything. Parts of each PPE that are not individually significant can be grouped and depreciated as a single component. So for example, you might take all the electrical systems, all the wiring and stuff, that would be part of the building, depending on what kind of building you have, and is it a plant, is it a high-rise, or what. Application of the components for the purpose of depreciation is required by both private entity GAAP, so ASPE, and IFRS. IFRS, of course, is more detailed and strict because they're dealing with public financial statements. So if you had components, your entry would be debit to depreciation expense and then credit to accumulated each of the components. Okay, so if it was the building, the roof, and HVAC, list them like that. You could also list them separately, it shouldn't matter. Now, on page 2, pages all stick together. On page 2, let's talk about the depreciable amount. Now, that means what should we be depreciating? So, it's originally calculated, the original cost of the asset less the estimated residual value or the salvage value, and we'll get to the rules in a sec. IFRS does not permit salvage value. ASPE uses salvage or residual. Okay? The residual value, because they sound the same, and they had been in the past used interchangeably, but since IFRS has come along and we've changed things, they aren't. So, residual value is the net amount expected to be received for the asset day if it was in the age and the condition expected at the end of its useful life. So that's the time, length of time we will use it. Salvage value, however, is the estimated net realizable value of the asset at the end of the asset's life. So when the asset's going to be scrapped. Okay? So, for example, you have a sales force and buy vehicles. Let's say you buy or lease, and no, I'm not going to talk about lease, I'm going to talk about buy right now. Buy your vehicles and you're going to use them for 7 years and then sell them. 7 years is the useful life. Okay? If, on the other hand, you're going to buy your vehicles and drive them until they can't drive anymore, and that's it. I mean, to fix them would be far more than the vehicle is worth. That's the asset's life. So what? How long could you drive a car? I guess it depends how your vehicles. Let's say it's 20 years, 15 years, something like that. Okay? That's the difference between useful life and asset's life, and residual value and salvage. So, the residual value should be reviewed regularly, annually under IRS. Depreciation continues as long as the residual value is lower than the asset's carrying amount. So you learned this last year. Don't depreciate the asset where the book value is less than residual. So if you're depreciating away, stop at residual. Straight line will automatically do it. Units of production should automatically do it. Yes, it should. Mostly, this is double declining where you run into this. So the double declining method. Okay, depreciation when the asset is available or ready for use. It ends when the asset is derecognized, so we get rid, or we classify it as held for sale. So at that point. So with this, this one. Under IFRS, if an asset is idle, so you're not using it for a while, let's say COVID, everything's frozen for 2 months. Okay, depreciation continues because we are assuming you will use the asset again. Okay? Because if you aren't going to use it, probably hold it for sale or you'll sell it. Okay? Now, an asset's useful life and physical life, as we talked about up there, are not the same. And remember, it's expressed in time or it can be units. So your vehicles, you could say the life of them is 200,000 kilometers, right? Your useful life might only be 60,000 kilometers. So useful life is sometimes referred to as the economic life. So if that wording, you know what it means. The period of time where the asset produces revenue. Now, factors affecting the useful life, how long we can use it. Economic factors like obsolescence, computers, right, out of, they can get too old too fast because programs won't run fast enough to crashes on. As any of you who have gaming computers know, the last few years of your life when you've been playing games, right, you need a new computer eventually. Physical factors like wear and tear, and the legal life, the expiration of contracts, which is all about leases in Account 16. So you're going to look at that next semester. Acquired sometime during the year, and we've talked about this before in this course, I think. Partial depreciation charges taken. We do not go to the nearest day. Not nearest day, because that's pretending we have very accurate estimates, right? 8 years. Well, can we look down and go, it's going to last exactly 8 years? No. So instead, we go to nearest month or half a year. Assume this unless told otherwise. Okay, now the depreciation methods. So these you guys should be familiar with, and you're going to review these on your own. So the depreciation should reflect the pattern of benefits from the use of the asset, just like inventory valuation should affect or match the flow of inventory. Now, it can also include simplicity, cost, as well as perceived economic consequences. So remember, we always want benefits to outweigh cost of our calculations. Okay, three main depression. Oh my gosh, maybe you guys are feeling that way now. It's the end of the year. Three main depreciation methods used are straight line. That's best when the usage is constant. So, for example, a building. Depreciation expense by year, harness residual over useful life. And of course, prorate if you need to. Here's the details on IFRS and ASPE. IFRS uses residual value and useful life. But ASPE uses the higher depreciation calculation of residual value and useful life and salvage value and expected life. Or what do we call it? Assets life. The physical life. So now, unless the question mentions a salvage value of X, you can assume salvage and residual are the same. Okay? So some questions will say, here's a salvage value, here's a residual value, and we'll just give you the residual value. Then you can assume that its salvage is the same. Okay, I'm going to change videos so I don't get cut off. Okay, see you in a little while.